With your jacket.
All right.
All right, Joe's going to be the MC today. Go ahead, Joe.
Fair enough. Welcome. We've got the Spring 22 equity reports for Friday, April 1st. Today we've got, what do we have here? Make sure I can count 5 pitches coming to us. The students have been working awfully hard on their models. We got everything from real estate to watches. So without further ado, if you can come on up. Danny, talk us through how you came upon this REIT, how you found it, how you screened for it, and if there's a lingering question on the chat board or something you want to address before we get going, that'd be great.
Thanks, Dr. Wolf.
Thanks.
Yeah, so my name's Danny Scelza, junior here in the AIM program. So kind of to start how we came about this company, my first pitch, I was doing an international healthcare company. That went well, but as a real estate major, kind of wanted to possibly expand into the real estate sector. So talked to Dr. Kraus. He said, yeah, go for it. See what you can find. So kind of did a little bit of both, best of both worlds. Found a healthcare REIT, CareTrust, that I really liked. They operate primarily in the skilled nursing facility industry. It's 71% of their total facilities in their portfolio. And, you know, the screening process really was just kind of finding an industry that, you know, had some opportunity. The healthcare industry has obviously been struggling, but as we come out of this pandemic, there is, you know, obviously some risk still associated with that, but some promising industry trends. And CareTrust was trading near its 52-week low of around $16. So I thought it was an interesting price point for where they're at. They've grown their dividend throughout their pandemic, you know, higher than most of their peers, 5.6 dividend yield, which is really good, again, especially through the pandemic. And yeah, so that's kind of how I found the company. And then for some questions, I was really getting into D2L, mostly related to risks. Obviously, occupancy rates are down industry-wide. I was asked a lot about that. And that's really driven from, you know, my other risks of tight labor. The pandemic obviously saw a lot of people leaving work in general, but especially in the healthcare industry with pandemic and ongoing infections. Over 400,000 people left their job in the skilled nursing facility industry throughout the pandemic. So, you know, it's a tight labor market and wages are growing. But as unemployment benefits, you know, kind of start regressing and coming off as we come off the COVID, you know, labor should be, you know, growing steadily back, and then occupancy should follow. And most of their big tenants, they've seen good occupancy trends over the last year, quarter to quarter. So, yeah, with that, I'll take it. Some questions.
Dr. Kraus.
Hey, Danny, we usually use different metrics than what real estate uses. Real estate talks about implied cap rate.
Mm-hmm.
So first of all, what do you know the implied cap rate for your firm, and put it in context historically or with its peers?
Yeah, their applied cap rate right now is a little higher than the industry average compared to their peers. It's about 7%, 7.1%. So, you know, as they're looking to sell a lot of their properties as they come out of this pandemic, you know, they're trying to get rid of the uncertainty in their portfolio rather than take a sit and wait approach. So selling these properties at that applied cap rate, you know, is going to be a challenge and, you know, increase, take some value away potentially. But that's
Yeah, so what's the closest metric that we tend to use for non-real estate that we could compare to the cap rate?
I would say probably, I mean, a WACC or
Or a return on invested
return on,
capital?
ROIC. So I did include ROIC in my boxes, which is, kind of not as appropriate for a REIT, considering, ROIC takes net income. For a REIT, I use, funds from operations, which adds back depreciation, and considering real estate as an asset kind of more tends to appreciate than depreciate. That, they don't really have, properties don't really have a shelf life. So, the cap rate is more closely attributed to the ROIC, and that's at 7.1%.
Okay, thanks. Questions from the audience? Yes, sir.
Hey, Jack Bender here. What a time to be alive, especially as a Cleveland Browns fan. Sean Watson and everything like that. This ties into my question as well, especially with new management coming in. Can you touch on about how Karina D. Williams is going to add value to your company?
Yeah. So thanks, Basil. You asked that in the D2L. She recently got elected after one of the board members recently retired. She brings an extensive background in underwriting, financing, and acquisitions from a lending service. So she has taken over this board position, and kind of like I said, as they start to underwrite and finance these new acquisitions and properties that they're re-tenanting and repurposing, she'll be very instrumental in that process. And management's really happy to have her on board. That's kind of her background and kind of going forward how she'll implement into the company.
Thank you very much.
So you pointed out, and I appreciate you doing some of this, right? You got some FFO techniques, but usually, did you run an AFFO model or an NAV model by chance?
At AFO.
Awesome.
Yeah.
And did you figure out where your cash flows are covered down to in terms of occupancy, since it's one of your potential risks? Did you kind of figure out where the break-even point might happen or any of that stuff?
Break-even point, I'm not exactly sure, but for, occupancy risks, I did
Some sensitivity.
Yeah, I did some sensitivity. And my rental income, that obviously top line affects adjusted funds for operations. Took a conservative approach. The street is really, and the company is expecting rental income to be, tight. They've collected 100% of rents the past 2 years, but kind of like I said, as reimbursement rates from Medicare and Medicaid slowed down to cover certain operating expenses for a lot of these properties. I attributed a 95% collection rate for 2021, grew that to 96% in 2023, then have it at 99% for the years after.
So that's pre-built into what we're looking, right?
Yes, correct.
So in your sensitivity, how far down did you go and what effect did it have?
If I was to do 100% occupancy across the board, it would increase upside by about 8% in my.
Okay. And is it fairly linear? Meaning, if I assume that it went down by 8, if I went down by in your first year 8%, then by 3, then by 1, it would have about an 8% drop from the.
Yeah, I didn't do a sensitivity analysis down, but
Okay.
I didn't go down, to.
No, that's fair though. I
90%,
just was
yeah.
curious. Cool.
Yeah.
Thanks.
Not trying to throw you off here. Nice dividend, 5.6%. In a rising interest rate environment, which it appears we're in and headed to, usually high dividend paying stocks are discounted because when rates are going up on a relative basis, that dividend doesn't look so attractive anymore. Comment how you expect, does the dividend change or does the company become less attractive as rates go up?
Yeah, great question. So, with rising interest rates, their cost of debt is low right now. It's, mostly tied to 2028 notes, only at 3.875%.
Fixed?
Yes, fixed. Yeah. And then they have a revolver and secured loan at low fixed rates as well, 1.6 and 1.5. So, their interest expense is low. They already announced their 2022 dividend increase about 4%. So $1.10 a share for the whole fiscal year 2022. So I did, project the dividend for 2022, as projecting a pretty similar year to fiscal year 2021, kind of flatline. I just assumed a pretty similar dividend growth rate of 4%. And their dividend payout ratio is pretty large. It's about 140%, which is, may seem unsustainable, but historically they've actually had, average 5-year average dividend payout ratio of 148%. So, it has proven to be sustainable. And, the dividend yield has been good. 2019 dividend yield was about 3.9%, so they have grown it through the pandemic. So I'm confident they can at least keep it up above 5%.
Yeah, Danny, really, really great stuff here. Just a question about expansion and possible retraction of the properties CTRE owns. Has management given any guidance on where they want to possibly expand or what kind of properties they're going to sell off here in the next couple of years?
Yeah. So in terms of expansion, they're obviously concentrated, being a healthcare and skilled nursing, kind of in California and southern states where older populations are more common. So they're not really looking to expand into newer states. But as they expand into the behavioral health industry, that's one of my third drivers. That's a really interesting space. I kind of talked about this in D2L. They have the capabilities, with not certain age demographics like healthcare. They have the opportunity to expand into markets they haven't really been in. So their tenant they have right now for the behavioral health facilities is headquartered in Tennessee. So for behavioral health, they're actually repurposing most of their facilities for expansion into that industry. But moving forward, that's definitely an opportunity to expand, more into the Midwest and even to the East Coast where they have little to no exposure.
Andrew.
Danny, really nice job here. My question relates to your debt and your dividend payout ratio. But obviously very highly leveraged company. Did you build any sensitivity analysis or look at different payout ratios and how that would change the valuation of this company? And could you talk to us a little about that when it comes to debt?
Yeah, so in terms of the debt structure, it's pretty straightforward. I mentioned about 60% of it is tied to 2028 notes. They recently took a prepayment penalty of their 2025 notes, so they paid all that off and took this on at 3.87% fixed rate. And then a revolver at 1.6% and an unsecured term loan at about the same rate. So, they do have a lot of debt, but it's pretty secure, pretty straightforward. So, in terms of their peers, they're actually less levered by about 10% of my peers' average debt to equity ratio. So, as they expand and, start re-tenanting and repurposing and buying new properties, they do have the capability to take on more debt. I did factor that into my model. I grew my interest expense about 110 bips next year, and then 50 bips after that. So, yeah. What was this second part of your question?
With their payout ratio, did you look at any changes in that? Did you guys not have any problems staying above 90%?
Yeah, so I really didn't factor that out, considering their payout ratio has been incredibly consistent, about 140 to 150%, which is well above the REIT requirement of 90%. So, it may seem unsustainable, kind of like I mentioned earlier. Historically, that's where they've been. So I kept that pretty straightforward, forward-looking.
Last question, Professor Walker.
How much of their business is considered memory care?
They don't do memory care. Yeah. So skilled nursing facilities, assisted living, and
Left field question.
yeah.
Yeah, one more. Professor Hunt, their growth, has it been fueled more by acquisition or in terms of acquiring large portfolios of other properties, or are they kind of doing it more on a one-off basis?
Yeah, they've always been active in investment, so it has mostly come through acquisitions. In 2021, they did about $170 million in total investments. And their investment initial yields have been pretty healthy consistently, close to high 7%, 8%. And even for assisted living facilities, senior housing, that's above 8%. So throughout the pandemic, investments have slowed down. But historically, that is how they've made most of their growth is through investments.
Have they acquired any other large, very large portfolios, maybe even other publicly traded REITs that are similar to their competitors?
They haven't acquired other REITs, no. They just acquire facilities and tenants. So their top tenant, Ensign Group, has been a very consistent partner with them. They own properties that account for 33% of their rental income. So they really have no history in acquiring other REITs rather than just internal.
Do you think that they may be a target for a larger competitor to acquire that?
Absolutely, yeah. That is possible. They are a relatively smaller REIT, only operating 224 properties. So that does make them, potentially suitable for a larger REIT to invest in, especially in this industry. And a REIT that has highest concentration of skilled nursing facilities that I came across in my peer analysis. So that is definitely possible, yes.
Thanks.
Right.
Appreciate it.
And then-
Michael, you know the routine by now. You can talk us through how you came on AGCO and got a key question, lingering question you want to handle, that'd be wonderful.
Thanks, Dr. Wall. So, for those of you who don't know me, Mike O'Donnell, I'm a junior in the AIM program. And today I'll be pitching AGCO Corporation, ticker AGCO, with a price target of $185.14. So, kind of how I came across AGCO, I kept my same screen for my first pitch. I like to keep it pretty open just because I feel like if I put too many quantitative measures on it, I can really rule out some companies that I think are good. And kind of in reading through companies, AGCO really stuck out to me, kind of for two reasons. The first being is I wrote my disruptive technologies paper on precision and digital agriculture. And I guess being from Nebraska, farm state, that kind of stood out to me. And the second being is I just thought when you're in an inflationary period, I think agriculture is a good way to kind of hedge against that. And I noticed the portfolio didn't have as much agriculture, at least industrials, didn't have as much agriculture exposure. One question that's come up a lot on D2L is I believe it's my first or second risk, and that's the semiconductor shortage. Semiconductors aren't just the semiconductor shortage is not just an AGCO risk. I feel like it's affecting a lot of different industries. And it's lasted throughout fiscal year 21. What I will say is, first being, AGCO had a really, really strong fiscal year 21. Their revenues grew about 21% and their operating margins grew about 200 basis points. So from that, I feel like they're weathering that storm pretty well. And they also are taking actions to kind of mitigate these risks. The first being, they're redesigning some of their products to take different chips. So that gives them more flexibility. So you're not as dependent on one chip, and then so you're not holding higher work in process inventory, kind of waiting for those chips to arrive. And then second being, and I think this is pretty industry standard, they're looking at different different suppliers of chips to source. So with that, I'm happy to open the floor to questions.
Dr. Kraus.
Yeah, let's talk about capital structure here, right? I know that was brought up on the D2L side as well. Talk about their capital structure, again, the debt that they have outstanding, anything you can tell us about maturities, fixed versus floating, et cetera.
Yeah, so total including capital leases, it's about 1.5 billion in debt. With that, so in 2023, they have 280 million in debt coming due, and then in 2025, it's 355 million. They have about 890 million of cash on hand. So I feel like at the end of the day, if you have that much cash with that coming due, I think that kind of mitigates that risk. It is fixed. So
this tends to historically be a very cyclical industry.
Mhm.
And right now, it's a very favorable cycle that it's in, particularly given in light of what's happening in Ukraine and planting season and agricultural prices, et cetera. At some point, are you concerned about this rolling over? And, you know, what tends to happen when agricultural prices are weaker? How has this company responded in the past when agricultural prices were weaker in their revenue?
yeah, so if you see in my boxes, I kind of have revenues tapering off to about, I think in fiscal year 23, I have about 4.5%. And from that point on, it's growing about 2.5%. I think 2.8 and then 2.5%. That's kind of my way of saying if, you know, kind of when that cycle does decrease, you have lower revenues. I think fiscal year 2022, they have strong outlook. And that's really just based on management guidance with kind of backlog that they have. And in that backlog, they've kind of assumed how the chip shortage has affected them and kind of will continue.
Did you
to
do a
affect
correlation?
them. Yeah, I did do a correlation. So
That's what I'm getting at.
monthly correlation with regards to corn and wheat prices, the strongest correlation is the 1 year, and it's 0.69 for wheat and 0.61 for corn. And then in the last year, wheat and corn prices with regards to revenues running at about a 1 correlation. So,
Okay, thank you. Tom?
Hey, Mike, nice job with the pitch. So, first question I have too, in regard to your first driver, talking about the precision agriculture segment, how that's kind of increased as a percentage of the overall total sales mix, improved your margins. I was wondering if you have any color specifically on what the margins of that segment are, and I guess how the non-precision segment of the business grew over the past, 5 years per se, and how you're projecting that in the years ahead. And then the second question is in regard to the semiconductor shortage you called out, and if the firms had any delays in actually shipping their products to their customers as a result of that.
So to address the first question, so the part about Fuse, so in their precision agriculture business, it's Fuse, which is more of the data aspect to it, and then precision planting. They don't specifically, when they break down their revenues, they do it by geographical segment. So it's hard to get actual color, and I was able to pull that number of, sales increase from an earnings call. So Infuse is intercompany selling. So essentially they're taking the software and selling it to their other products they've vend, for example, and then they would be able to kind of see from that. They call it a margin-rich segment, so that leads me to believe that, it is, and their operating margins have been increasing. So as that becomes a greater percentage of revenue, I'm saying, well, if it's margin-rich and, margins are expanding, I feel like that's the higher margin segment. To your second question about the semiconductor shortage, so their inventories increased about, I think it was somewhere in the neighborhood of 700 million. So that's mainly because they're holding higher raw materials to kind of try and mitigate those risks of the semiconductor shortage, as well as higher work in process inventory with those, tractors or whatever part that takes those semiconductor chips, and just kind of waiting for them. So.
Professor Walker?
I'm a big fan of degree of operating leverage, and I use the term incremental margins. When we were talking about the due diligence, I noticed a couple of years they had really substantial incremental margins. One year they had 100% incremental margin, meaning for every dollar sales they increased, they had $1 profitability. How that tells me that they've got to be having actually supply costs dropping per unit. Are you maybe confusing the fact that the costs have dropped and you're making the assumption that margins are rising because of the higher value added, but discounting the cost dynamics that may be going on in the company?
So what I will say to that is I spent a lot of time looking at SG&A expense because that part of it alone I felt like was really, while margins are expanding anywhere from 30 or 40 basis points if you exclude depreciation and amortization, their SG&A, so in fiscal year 17, it was about 1.9% of total revenues. And then when you go to fiscal year 21, it's about 9.8%. And from what I've been finding is in past earnings calls, they really reference going through their SG&A and finding ways to find cost reductions in there. And also in fiscal year 20, they rolled out a CRM platform, which they've been taking out to their dealers, which I think has helped with that SG&A aspect and kind of growing those.
Just one more follow-up. In the last 3 or 4 years, have gross margins increased every year during this period of time, or have they been relatively flat?
So in fiscal year 18, I believe they stayed either dropped by 10 basis points or stayed flat. But after that, they've been incrementally growing. What's up, Dave?
Hey, Mikey, quick question here. What's your country risk premium?
So considering that they only do 25% of their revenues in North America, what I did was they break out countries that they use or the countries that they have sales in. And I just went on Domadoran's website and then did a weighted average and just multiplied that by the country risk premium. And then I added 92 basis points from doing that.
Yep, Tom.
Yeah, so Mike, I saw you called out a pension plan as your first risk. So I was wondering if you could kind of walk us through if you did any sensitivity analysis on how what the dollar impact of changes to the discount rate or expected rate of return would have on next year's earnings.
Yeah. So I did not go through what they would be to next year's earnings because really that was, so in the 10K they lay out plus or minus 25 basis points and what plus or minus 25 basis points of what that would do to their obligations. In general, they have really low discount rates. So their old plans, which covers every country outside of the US, they're discounting at about 1.5%. and the US they're discounting at 2.75%. And from there, if you, I guess, do a sensitivity analysis, it's about 22 million, negative 22 million, and then positive 22 million if you do plus or minus to the discount rate for all plans. And then the US was about 3.6 either way. So
This firm has a lower price to earnings than its peers. Has that been the case historically?
Yeah.
Okay.
Yeah.
Why do you think?
So I think part of it is, so the two competitors that they call out in their 10K is CNH and John Deere, or Deere and Company. I think Deere and Company has a very strong name, I guess, in the United States. And if you're saying that the United States could be driving a lot of, I guess, PE multiples, I think that can really affect it. And also they utilize effective tax rate pretty interesting. So in some years they'll have higher effective tax rates, and in some years they'll have lower. So in fiscal year 21, they utilized an 11% effective tax rate, which really made their EPS expand, which essentially brought down their PE. And then in some years they'll use a higher effective tax rate. So.
Yeah, Chris, just kind of a question on your competitors and a little bit of your third driver. Obviously, big competitors, John Deere has a big name, kind of a big reputation. What do you think that AGCO can do to kind of gain that market share, and how confident are you that they can kind of steal some of that market share from, I guess, John Deere and others?
So what I will say is Deere and Company, about 50% of their revenues come from North America. And then if you look at AGCO, it's about 25%. So I think it's not as much taking market share, but it's more of an expansion globally. And they've really been focusing on South America and the Asian market, which I don't think Deere and Company has as much of a footprint in. And then what was the second question again? Or was there?
Speed round, yeah. We got one question each. What do you got?
Yeah, perfect. Great job, Mike. Does AGCO offer any like financing to help farmers when they're buying this equipment? I know like John Deere, some of the larger competitors, they offer financing to make it more affordable, easier for them to get the products and stay with the brand for longer.
Yeah, I'm blanking on the name. It starts with an R, but they do have a financing service like that.
Perfect.
Do we still own Titan Machinery?
Yes, correct. Yeah.
So, like, why do you think we should have two ag companies in the portfolio, or was that going to be your sell?
So I was thinking, I think I will propose selling Viker, and it's down about 43% year to date. So
why should we have two, to her point, then, if we're going to keep Titan?
So I think kind of twofold. I think having exposure to agriculture in kind of this period, I think is good. And also, so Titan is a main distributor for CNH, and I think kind of when you have those two together, I think it's good exposure. So.
All right, thanks. Same thing, Grace. Grace is going to talk us through her love of boating and fishing. Any questions about Warner Technology? Grace, go ahead. Take this away.
Thank you, Dr. Wall. My name is Grace McCrea. I am a junior in the Applied Investment Management program. And today I'll be pitching MarineMax, ticker HZO. I cover the domestic consumer discretionary sector. So a little bit about my screening process. I used FactSet and FinViz, and I really wanted to find a company that I guess kind of dominated like the industry, especially against its peers, which I think MarineMax does really well. I can talk a little bit about like the rel-val and those multiples, but so yeah, that was kind of my screening process. I also wanted to look into a company that was less financed with debt. Their debt to equity ratio is like about 31% debt. So that's something that I was also attracted to with their high cash balance and their many acquisitions. And I don't think there were any outstanding questions of D12. So
great. What's the price point of these boats? Do you know, like in terms of if I was going to buy a boat, what kind of consumer would be doing that?
Yeah, so it's a pretty wide range. They sell from 12,000 to 35 million. So it's a really wide range, but their average selling price just moved to.
Well, I'd probably want median if that's the range, right? Because average would be everything in between. Do you have any, like,
I don't
where
have
their
a
strength
median.
is?
Well, like the average selling price was $227,000. So
But it only takes $135 million boat to offset.
right.
Okay, no, that's
Um,
that's fair. I just didn't know what we're dealing with, what kind of consumer.
Yeah, they really don't break down the sales into the brand and the price, so I'm
Okay,
not sure about that.
Thanks. Dr. Kraus.
Relative value, I'm really surprised at this company and the peers, how low the PE and enterprise is. Have you gone back historically to look at what multiples were for this group or industry?
Yeah, actually, for MarineMax, they've been quite steady, especially the PE and price to sales, which I know I didn't include that, but I did a rel val of that. And it was actually more difficult to find peers that I thought were great because like One Water Marine, which I have weighted at 40%, is like the ideal peer. They basically do the exact same thing. They're just headquartered in Georgia. And then Mastercraft Boat Holdings does manufacturing, but mainly selling. And then Marine Products and Brunswick, which I have weighted a little bit lower, are more manufacturers, but that was really the closest I could find.
Thank you.
Sure.
Chris.
Do you have kind of some of the revenue growth rates before 2020, 2021? Just because I know the boating market has exploded since COVID started and everyone's trying to find any boat they possibly can. So I'm just kind of curious how they grew before and if they're going to kind of return to those numbers or.
Sure, yeah. So in 2021, you can see in my box about 37%. 2020 was about 22%. And then 2019 was, I think, about 6%. And the years before that were pretty steady around 10 and 11%. And I know like this industry is really cyclical both in terms of during the year and years. So like in a 5-year period, normally they have 2 years in a row that have pretty high revenue growth. So like 2020 was that 22%, and then 2021 was that 37%. So that's kind of why I have it going back to that like 12% for the next 3 years. Just that's how the industry and this company specifically has been.
Do you worry about like a decrease in sales after pretty much everyone that wants a boat has tried to get one or has gotten one in these past 2 years?
Yeah, sure. I had a question like this on D2L. They asked, like, what's the turnover for like someone that buys a boat? Like, how often do they want one? And I was not able to find that, but I mean, the average life of a boat is 10 to 25 years. So, I mean, for people that boat, and when like the average life of their boat is up and they're ready to buy a new one, they're always gonna, want a new one. And that kind of goes into the customer service. They have like 85% loyalty of customers. So I imagine that those customers will be coming back to them,
So I have a couple questions. First, right off the bat, I think you did a really great job. This is a great company. Have you ever used any of their boating brands or been on one of their boats before?
My family has like a CTRE boat,
Okay.
but they don't manufacture, so.
I understand that. Do you know what kind of margins they're making on these boats? Because obviously I'm looking at the brand names right now. I know the boating industry pretty well. These are some pretty high-end names. I'm sure the manufacturers are charging high premiums on them. What kind of margins do they make right now? And do you have any concerns about them contracting as boat prices go down?
Yeah, sure. I don't know the exact margins on the brands. The MarineMax just is not very detailed in breaking that out. But I do know that 27% of their revenue comes from Brunswick, which manufactures like a bunch of different types of brands. And they have, like MarineMax is the exclusive dealer of 6 brands, which is like a really, I guess, big number compared to other players in the market.
So, similar type thing. This is your second pitch, right?
Yeah.
You've done a good job. So I like taking folks that have done a good job and push them a little bit. And so I'm going to ask you, and this is something I want to see out of all the classes. Did you do any kind of either sentiment analysis or scraping of reviews to try to get a sense of how this rates out versus, Mastercraft, your competitors? Did you do any of that sort of work? Do you have any sense of things?
Yeah, I did. So I looked on customer reviews and let's see, Facebook, Yelp, and then Glassdoor and Indeed, which I know that's for someone that works there, but I wanted to get both. They had all overwhelmingly positive reviews. I did, of course, there were a couple negative on, I think it was like Better Business Bureau, but in every single like review, MarineMax has like commented back and said obviously like their response and defended themselves, but most of the complaints that have come over the past year have been related to like supply chain, which MarineMax is like doing.
But if I
everything
wanted
they
to
can.
buy a boat and I had a lot of money, would I be happy with what I saw in the reviews?
Oh, yeah,
Okay,
yeah,
cool.
certainly.
What do you got?
Yeah, great job, Grace. Just a question on kind of your forecasts and assumptions. I see you have operating margin kind of contracting a little bit from 21 to 22. Can you kind of explain that decrease as revenues going up and then that sudden contraction of margins?
Yeah, sure. Operating margin historically has kind of been all over the place. You'll see like the operating income growth was nearly 100% in 2021. Management did give some guidance that costs would be increasing in this year, fiscal year 22. Cost of goods sold just because of their new acquisitions, and then SG&A because they weren't able to participate in those boat shows last year with COVID. So now that they're going to be participating in them, that just kind of increases those costs. So that's kind of, that's kind of where that comes from.
Perfect, thank you.
Thanks. Professor Wall.
Just a question, it seems like the last 5 years, the company has been buying more companies that actually make boats rather than service. They've doing marine service, all the work that's done on, not only buying the labels. I mean that if we go to recession, that would be a much bigger risk. Do you put that, any risk factor into your WAC at all in terms of increased volatility, given that you're buying these labels?
Yeah, sure. I did not end up using the risk premium that I put in, but I had that in my model and I ran it with that, and it was still about 55% upside from the DCF.
Nice. Thank you. All right, thanks. Here comes Grace. Come on up. Pitching us a variety of technologies, but as I told her early, since it's April 1st, the first one I see, this permanent hair reduction technology, I have perfected it without cost, so I'm worried about the process.
Yeah, I'll add you to my peers.
Yeah. Take us away.
All right, well, thank you for that wonderful introduction, Dr. Wall. My name is Grace Schwartz. I am a junior in the AIM program, and today I'm pitching a company called InMode. Kind of to go into my screening for this, I did have 3 months of missed classes to kind of figure out a bunch of companies that I wanted to use. And InMode was actually really exciting to me because I actually saw them present at a women's health conference. So kind of in the back of my mind, I always thought they had an interesting management and it was an interesting product, but I never really looked at the actual financials of this company. And when I did, I found that it was a company with a really strong ROA, ROIC. It had a really great balance sheet, a lot of cash, and I also really liked the management. So one more thing that I would like to address before into any questions was the obvious mistake on my part with my original write-up that has led me to change the valuation of InMode. So I was researching their capital lease structure and basically overestimated the amount of leases that InMode actually has. And this led my WAC to be a lot lower than I originally had anticipated. So I reevaluated it and I have increased the WAC to 10.62. And now I'm pitching a target price of $51.81, which is a 39% upside. And without questions.
Dr. Cross.
This company has excellent margins, right? This is some of the largest operating margins we've seen in a long time. And as a result, ROA and ROE are very high, okay? Is that sustainable?
Yeah, I definitely think that's sustainable. The kind of way that they've been able to keep their operating or just like all their margins pretty high has been because they actually outsource their products. So they don't have a lot of it. They have a really low inventory. And basically the way that they've done that is through certain contracts with these two manufacturers, and they basically organize it at the beginning of the year. They get to have fixed prices for all labor, materials. Basically, the entire cost to produce a platform is fixed, and that's kind of how they've been able to.
So this is an Israeli company, but
Yes.
where are those manufacturers located?
The manufacturers are also located in Israeli, and I'm kind of sensing what is the risk of that? But I've accounted for that. I actually put 100 bips for a country risk premium, which is higher than the Domidoran risk premium that they gave, so I increased that. Additionally, I've been super conservative with projecting out revenues, so the company, I guess just to give you, just for reference, in the past 5 years, they've generated a CAGR of 45%. I projected that out for the next 5 years to be 15%. So just trying to be as conservative as possible if there are kind of blips in supply chain or manufacturing.
Okay, thank you.
Yes, sir.
Hey Grace, really, really good job here. Would you happen to know, the cost of acquiring each customer for Inmo?
The cost of acquiring each customer.
Yeah, like each individual customer, like how much does it cost from like a marketing ad spend, that sort of thing to acquire?
I don't know that particular number, but I will say, so they are business to business, so their actual customers are physicians, like surgeons, people that want to bring that to their company. So it's not really on a customer by customer basis. I can tell you that, like, do you want me to talk?
I mean, like, how much does it cost to, I guess then, how much does it cost to acquire a business? I'm just trying to understand.
Yeah, so basically, I can't really break it down by marketing. I don't know by marketing, but it costs like $120,000, $130K to purchase the platform.
Okay, perfect, thank you.
Oh, look at me, look at you all.
Yeah, sorry. Is there anyone else? Anyone, anywhere with a question at all? Anyone?
Yeah, so
Oh, over here, Andrew.
Yeah, Grace, nice job here. Are there any equity research firms that cover Inmo currently on Wall Street?
There are a lot. In fact, Baird covers this company, and I kind of decided to not really use that as much because a lot of the equity research sell side stuff had a beta of 0.9, which I didn't really think was appropriate, but I did look at kind of some of their estimations.
And so you said you were being very conservative with your revenue estimates. How did your estimates compare to the street? Kind of why did you differentiate from the street compared to us?
Yeah, so a lot of them, I guess just one example is tax rates. So right now, InMode pays a tax rate of 0.5%, and management has kind of talked about this, and they project it to be about between like 2.5 and 7.5, but I ended up modeling it as 11.5% and then kind of increasing it just so that it's more towards like a corporate tax rate, but that's just one example.
Again, we have a discrimination against cats policy, so we preference human questions first, and then we follow cat questions. Any humans? Oh yeah,
I
yes,
got her
sir.
right here.
Yeah, so you're saying you're being super conservative. So my question is, what is the market missing here? Because if you're projecting this at a much lower market than Wall Street, then like why is the stock so low, and how do you still have so much upside with the market having higher projections? Like if you're being super conservative, then like why is the market so wrong on the stock right now?
Like why? I think a big portion of that has to do with kind of like what's going on in Israel right now, and just kind of that unknown aspect of it. But also I think it is like within the AIM philosophy to invest in things for the long term. So I don't really think that, I mean, if you go back, like I don't really think that that's a good representation of how the company's doing right now, especially as they're beginning to release more products and expand to more countries. Thank you.
All right, Mr. Meow Meow, what do you got?
All right. So I just want to say nice job in your write-up on how you separated the Kardashians and Amber Rose. Because according to my notes, Amber Rose dated Kanye, who is in trouble with Kim. And she also dated James Harden, who was with Jordan Woods and with Khloe. So anyways, back to my point. Especially with all this tension, tying this into your, asset-light model, how will Inmo generate consistently robust top-line growth to boost your bottom-line growth moving forward?
Yeah, I think that kind of goes into the last question. InMode is really upped their sales and marketing. So now that they've acquired these patents and they have this technology. They're really working a lot to market this to other countries. So especially right now, they're in 71 countries, right? Or they're in 71 countries. In this past year, they moved into 17 more. And their big focus this upcoming year is in China, and they're really hoping to take that on. They already have offices there, but because of China's coronavirus policies, they haven't really been able to establish themselves much, but I hope that answers your question.
Professor Walker, what did you use your PE 2 years out and not EBITDA?
Yeah, that's a good question. So the relative valuation portion was a little bit tricky, as you know, because we were looking at a lot of different peers and kind of trying to find a good valuation. Basically, this past year has been really difficult for a lot of medical device companies, especially medical device companies in the aesthetics market. So what I was finding with my peers is this past year, a lot of them had super increasing or super decreasing revenues. So they were kind of all over the place. I'm estimating that 2023 will probably be a lot more stable for the peers, which is why I use that.
Andrew.
Yeah, could you talk to me a little bit about your beta? It's extremely high, one of the highest I've ever seen on a write-up.
He's a senior, so he didn't see your response in the B12 site.
Yeah, so I do have.
And I didn't put him up to that.
No, I do have a new write-up. Basically, when I was calculating that, I used the S&P 500, which I kind of found that a lot of those companies don't really meet or don't really match InMode's. So one thing that I did to kind of fix that beta, because it was so high and I didn't think it was an appropriate valuation of risk, I looked to the correlation between that and the Russell index, and those are a lot smaller.
August.
Yeah, I'm just curious, how did you account for your first risk in your model?
I'm sorry?
How did you account for your first risk?
The sales and marketing?
Yeah.
Yeah, so that's kind of also why I measured revenues being lower, because if they can't meet with people, or like if there's not enough sales and marketing professionals, they can't sell the product or reach as far as they'd like to. So that's kind of how I accounted for it.
Yeah, so I noticed that your CEO and CTO divested more than half of their positions in the company at the end of last year, and the insider holdings is still pretty high, about 17.3. So I was wondering if you just had any comments on, why you think they did that, or if that concerns you.
Yeah, definitely. I did look into that a little bit, and I wasn't able to find like a specific answer. All that I can kind of maybe assume happened, if you look at like what they're paid versus what their peers are paid, they're paid a lot more in stock. So I think that could have been a reasoning for it. They still hold a lot of the company. So I know they owe like 2%, 4%, and 9%, all the co-founders. So I think it still shows that they have a lot of.
But they made no statement about why they sold half their holdings.
Was it?
About 210 million between both of them.
Between both of them.
Yeah, and I think the CTO went from about 9 million shares outstanding.
I'm not saying they did. I'm just curious. They
Yeah.
usually make a statement when they sell that much.
There was no statement about like aside from like tax purposes.
My suggestion, Grace, is before the write-ups go out, or the buy-sell goes out tomorrow, you kind of peek and figure out
definitely.
what that might have been.
They should have issued a 10Q to state that.
Yeah.
All right, I'll look into that and let you know. Thank you.
Yeah, it looks like the end user of your product is like med spas and plastic surgery type institutions. I'm just curious, how fast is this market growing in the US? Like how many of these like places exist, and what's the projected growth for those? And are there any like big players that we should like, any notable players in that industry?
What, are you curious about?
We were talking about this today.
Very
It is.
No, you man, I'll hook you up after.
Yeah, I did look into a little bit, and I talked about it a tiny bit in my write-up. There's like a little blurb, but basically the global medical aesthetics market is forecasted to reach 15.9 billion by 2025. This would be a CAGR of 10.9, and of this market, InMode has been able to capture about 29% of that. So.
Okay, thanks.
All right, thank you very much. Harvey. Come on up.
Yeah.
We're here to learn about an exciting new technology called watches. Brand new. I'm curious about how you found this really cool tech. But no, take us away on how you found it, please, and then if there's anything out there you want to address before we get rolling.
So I'm pitching watches of Switzerland Group with a current price of $15.55 and a target price of $19.57, representing a 31% upside. So in terms of finding this stock, I was looking for a company with a history of consistent revenue growth, a proven track record of navigating through economic volatility, and still with a significant opportunity to continue its growth. The luxury Swiss watch market really stood out to me because of its secular growth, where industry prosperity is much less dependent on general business trends and economic cycles compared to other industries. Given the current macroeconomic landscape of high inflation, rising commodity costs, and the fallout from the war in Europe, this was particularly relevant to me. One of the common questions was based around the high revenue growth in 2022. This large increase in revenue is derived from the 2021 acquisitions of the online second-hand watch marketplace Analog Shift, plus the takeover of 5 large Betteridge dealerships, which alone will add $100 million in revenue growth. Finally, they recently launched a US e-commerce platform, which was a great success, and this caused e-commerce sales to grow 120% in fiscal year 21. That's it.
I have to look at that debt equity ratio. That's not percent, 1%. That's
No.
a time, 1.2.
Yeah.
From what I understand about this business, I'm surprised because it doesn't seem like there'd be a lot of fixed assets.
Sure.
So help me understand the capital structure, and if you know anything about the debt structure, tell me that too.
So I probably did myself a disservice. That's actually long-term debt. The multiple I gave was long-term debt to EBITDA, which is 2.5.
So this is long-term debt to equity?
Yeah.
Okay, thank you.
So I pretty much did myself a bit of a disservice. But when you break it down,
Does this include capital leases?
yeah. So capital leases are 61% of the current obligations, which is a significant portion. But yeah, when you look at net debt on the 2nd of May 2021, it was actually 43.9 million. And this is a reduction of 85.8 million pounds from the year before. And this takes net debt to adjusted EBITDA to 0.42 times.
Those are the numbers, but what kind of debt is it? I mean, it's
Floating
floating, fixed,
rate debt.
okay. It's all floating.
But they've purchased a series of derivatives and hedges. That,
Swaps.
Yeah, swaps that manage the debt and keep it low.
Okay, denominated, this is dollars?
It's pounds.
Pounds,
Yeah.
okay, thank you.
Yes, sir.
Hey, great write-up, Harvey. I noticed that the stock is pretty illiquid on the OTC market. The last trade was on Monday, and the current ask is $20 a share. Have you built in any of that into your WAC?
Yeah, so in my WAC, I added Damadorian recommends a 0.6% market risk premium for the UK. I added a 1% to consider that low volatility, not volatility, low volume, and the country risk premium.
Okay, thank you.
Yeah. So yeah, no, that's actually a really good point you bring up. When in a liquid issue, we're going to have to figure out a way to put a limit order in if we were to do such a thing, right? I think if it's a $5 wide spread, I don't want to buy at the market.
Baird will take care of this.
Oh yeah, they will. I love Baird, but yeah. Yes, sir.
Harvey, love your accent. I just got a quick question. How does Russia actually affect them? Because I noticed that some of their manufacturing is based in Russia.
No, none of their manufacturing is based in Russia.
Really?
Maybe that. I mean,
well, they don't manufacture anything to begin with. Aren't they a reseller?
Yeah, Russia. Yeah, they don't manufacture anything.
Yeah. Completely lost on words.
Russia did actually recently seize a series of.
Yeah, that was the question. Yeah.
Yeah, they're not owned by. So Russia recently seized hundreds of millions of dollars worth of Audemars Piguet watches from AP dealerships in Moscow, but they're not tied to the group. So in fact, it actually helps the group.
Flop.
Wow.
Andrew.
Yeah, Harvey, great job here. Love this company. I think it's really unique and has some potential for really good upside. Could you talk to me about these floating rate notes and the derivative swaps they have to accompany them? You know what kind of swaps they are, and what limits they have, and how much they're valued at?
Honestly, thanks for the question. Off the top of my head, I don't actually have the specific details on that right now, but I can definitely find out for you and get back
Yeah,
to you.
please send information on that before you sell out your buy sell,
Sure.
because that could have some pretty big risks associated.
Yeah, we saw this play out, right? Last time we had debt crunch 08, people that were backed up by credit default swaps that didn't work out so well. So good point. Yep. My question is going to be, Harvey, you've come along a nice way. And again, just like Grace, is your second pitch. So I feel compelled to raise the bar a little bit. And so what I want to know to start the conversation is when they buy watches, what are they paying in? What kind of currency?
All of their financial statements are derived in pounds.
That's not my question. What are they paying for their product in? You know how they're buying it? Are they paying in pounds or not?
I'm not entirely sure.
Okay. And then that's fine. It's not a problem, but you know where I'm going to head with this. I want to know how you set up your hedge against the pound, given the pound with the Brexit has been a bit more volatile than the euro. Did you do anything to account for that?
I just added in the risk premium.
Oh, no.
Currency risk premium.
Please, from now on, please model currency risks out, and I'm glad to work with you. You have the skill set.
I did that in my first pitch.
You did. That's why I know you have the skill set. Take it easy in your second pitch. We want to see you get better each time.
Sure.
You're good. Like, this isn't a comment on your pitch. It's a comment like you have the skill set. So let's keep it going. Sure. Cool. What else you guys got?
They're expanding into the US.
Yeah.
Why not? I know this was on the board, but yes, US, why not China? Because isn't that the society that wants to own hard assets, inflation-proof, denominated in pounds and dollars?
Definitely. So far, their efforts are focused in the US. They've considered US a significant growth opportunity. Spending per capita on luxury watches is actually 3.5 times lower in the US and the UK, hence why they've put so much resources into expanding to the US. So far, they have not indicated that they plan to move into China, but I think once they continue to establish more of a foothold in the US, they may well look to do so.
So are the investors, or are the individuals buying the watches, treating them as investments, or are they wearing $100,000 Daytona racer Rolexes on their wrists?
I mean, it's different to each individual customer. Both really, you can certainly do both. For example, between 2015 and 2025, Rolex, Patek, and AP watches are predicted to appreciate 69%, which is a great indication of the value they can increase by.
I don't know if you had a chance to look at correlations with this and say the art market or other collectible markets, maybe Chinese ceramics or rugs or anything, or other forms of jewelry. Does this mimic those markets?
Yeah, certainly. But it's hard to break it down because Watches Switzerland Group doesn't just sell a Rolex or an AP. It sells quite a wide variety, and each different brand, each different model will vary in the amount they appreciate.
Yeah. But I have a similar question that would be pretty cool. And if you didn't do it, I wouldn't expect it, but nonetheless, it'd be fun to look. Did you either look at the correlation of what happened in 08 when a bunch of art collapsed, or did you look at the spread between the used watch market and the new watch market to see if it's maintained or grown over time? Because I would argue a lot of this is being driven by the underlying used market appreciation.
Yeah.
And did you have a chance to look at any of those sorts of things in any form?
Yeah, I didn't do like a comparative model like you said, but the used watch market is definitely one of the reasons behind this huge demand right now.
So I'd be super curious to know what that spread is, if it's consistent or growing or shrinking. Okay, if you could, I would actually like to follow up. If you can at least give me one data point to help me understand that, that'd be great. Thanks.
Do you know when they went public and how they went public? Was there a vehicle behind them?
They went public in 2019, so they've only been public for a few years. I'm not entirely sure of how they went public.
Well, and then my last challenge to you, I haven't had to do this in a long time, but it's because of the opening pitch. If these markets are $5 wide sometimes, could you please tell us an upper limit price you feel comfortable with us paying? Obviously, we don't want to buy this at $100, or if you think we should, tell us that. But could you come up with a maximum limit price you feel comfortable owning it at?
Well, when I compared by
you don't have to do it right now, but I'm saying, could you, before we buy it, could you tell us what our limit is?
Just so everyone knows, this stock is very actively traded in London.
That's right.
The U.S. equivalent
Not
is
so
traded very thinly in the over-the-counter pink market, as it's called. And so it doesn't trade every day. When it trades, it's chunky.
Yep.
And there's a bid-ask spread that's fairly sizable.
So we may have to put a bid in and let it sit, and then
hopefully someone will sell to us, and now we've established our price. We just don't want to overpay because of the width of that market. Cool.
All right.
Thank you so much.
Thanks, Harvey. All right, so Dr. Wall is going to talk about this because right now the class of 2024 is in different parts of the room, meeting some of our seniors and our younger alumni to learn about different functional areas. And I believe at 3 o'clock, they're getting together in room 105.
Yeah, and you guys are welcome too. We got some pizza and all that kind of stuff.
What kind of pizza?
I don't know what Jess got.
You don't know? Ian's.
Ian's.
Oh.
We went big.
We're spending the big bucks.
Yeah.
All right, everybody have a good weekend. Those of you who presented, let's come up and talk about buy, sell, and we'll get the balance out tomorrow morning. Right? Yours will be the first one. I started it, and then.
There you go. Yeah. Until next year.
I like the she got a bit of humour to the table.
I was like telling her, I was like, I was like on my team.
Great. Thanks, Alex. Oh, really? Yeah, we should. Thank you. Good idea.